Sequels are generally never as good as the original. They tend to simply make it worse. Well, in the financial world, it seems to be the same. This toxic financial product has made a major comeback, and it won't stop growing until we get to the next bailout plan. You came here for the truth, so let me unveil that for you. Today we are going to get into derivatives. Let's begin with this article out of Bloomberg. The comeback in complex credit derivatives blamed for exacerbating the global financial crisis is picking up pace. That's according to new research this week from Citigroup, one of the biggest arrangers of so-called synthetic collateralized debt obligations. This is something I talk about in my first book as well as my second book, and I actually have a diagram of the CDOs and what I consider it to be. Sales of the product may jump to as much as 100 billion this year from about 20 billion in 2015. So we are looking at 5 times increase in a 2-year period. While investors suffered billions of dollars of losses on similar bets a decade ago, the leverage offered by synthetic CDOs is luring buyers back in an era of low yields and dwindling volatility. So of course, this is what I've been talking about. You have investors chasing after more profit. If they can't find it in government debt, the fixed income category, they're going to go to stocks, they're going to go to all these derivative products. And this is unfortunately the worst kind. It would seem as if the low spread, low vol environment similar to back in 2006, 2007, when investors couldn't get enough levered synthetic tranches, has revived some of the interest in portfolio credit risk. Investors may not have necessarily wanted to have leverage, but simply put, they had to, given the lack of alternatives. You see that? They're being forced into riskier and riskier bets. This is not going to end well. The same situation 2006, 2007, and today we are encountering the same mess. It's going to happen, except there's much more at risk today because nothing was corrected from the initial crisis. So Citigroup, what about them? Well, if you remember, this is back from 2011, but essentially what we're looking at here is the bank that exposed the federal government to the greatest potential loss during the government bailout was Citigroup, which received a grand total of $476.2 billion in cash and guarantees, according to the Congressional Oversight Panel. That's the TARP program, all right? $476 billion because of this garbage, because of CDOs, because of derivatives, because of subprime. All of this garbage is linked together. So when you look at what are CDOs, you can get some pretty complex explanations for this. Basically, it goes through in this direction. You can read it if you're interested. I have a better explanation for it. It's garbage. Look carefully though. It's not just any garbage. It's sealed in a package. And if I were to label it CDO and I were to sell it to investors, well then it wouldn't be garbage. It would be a financial asset. And that's what's happening. I mean, I could look at all of the products inside. Okay, I could say, okay, this is one product, this is another product, and this is another product. Each one of these could be worth something. And within this, I mean, this one could be from New York. This one could be from California. This one could be from Detroit. This one could be from, let's say, Tampa Bay. All different places, different cities and states. And therefore, it's diversified. And that's correct. It is diversified. But what is it? Well, it's garbage. And that's exactly what these derivative products are. I actually had an argument with an individual, just a personal story here. I tried to get my book with Scotiabank and have them promote their Scotia Makata business, which now is going under, that I would recommend their bullion sales in my book. I wanted to talk to them. Anyway, let's not get that far. But so I spoke with a gentleman and gave him a chapter of my book, and I said, this is what I'm interested in. This is what the book is going to be like, and I want to have a place where people can go that they can buy their precious metals. I don't want anything in return. I just want to make a recommendation. I've purchased here before and found that it would be it'd be a good place for people to get it from, just in my personal experience at that time. And so I spoke with that gentleman. I spoke with another person in the media department, and that gentleman told me there's nothing wrong with derivatives, and you're making false claims in your book. And of course I rebutted, and it didn't go very far. Let's just put it that way. Because people on the inside, they don't see it like that. They see the sales, they see revenues, and they don't understand, when you look at it, what it really is. It's a pile of garbage. And I should have known better right from the get-go. You shouldn't be dealing with these banks in any way. And, Anyway, that's just a little personal information. If you want to know about CDOs, if you want to know about derivatives in general, you can read the book, The Big Short. It's a very simple book, but it's a good book. It tells you a good story in there. I think it's interesting. If you haven't read it already, and if you're not into reading books, you can always watch the movie, The Big Short, as well. I've read the book and watched the movie. Both are great. It just gives you a real tidbit of what this is all about. Switching gears a little bit. Wide dispersion between asset price inflation and real economy inflation. Total return performance in local currency since January 2009. Look at the real economy. And it's not even that real. I mean, we're looking at the GDP, fake numbers. But you can see where it is here. And then you look at all of these other assets. For example, S&P 500. It's gone up right here, I mean, probably 225%. And then you compare that to the GDP, not even close. Not even close. The stock markets have gone ballistic when you compare them to the real economy. You know, whether it's, for example, the US CPI, the US GDP, these things are nowhere near the asset prices. Nowhere near them. Whether that's for good or for bad. Credit bubbles by country then and now. The lesson from history: credit bubbles always burst. Household plus credit debt as a percentage of GDP. You could see these different ones here, I know, going back from 1980. And it's just interesting to see. Japan property and stock market bubble. Japan's the last 2 decades. You can see where that has had. And essentially, what I'm seeing here is Australia, China, and Canada all pushed up to these levels here. And it seems like nothing has ever been able to exceed this level in these cases anyway. Where does that leave us? The ominous credit bubbles today. Well, we saw what the bubble looked like with the US and the housing crisis starting from subprime. You saw all of these derivative products, whether it's the CDOs, credit default swaps and any other financial instrument that they decide to make up, it seems to me that we are simply headed in the same direction yet again. That's all for this video. If you found it informative, please give me a thumbs up. And last but not least, if you found this video informative, I know you will find my books, The Money GPS, and my newer release, Global Economic Collapse, even more informative. You can actually flip through these books. If you go over to Amazon, they have links in the description below for you to check out where you can flip through the books for yourself. Take care.